Welcome to RBC's Markets in Motion podcast, recorded June 8th, 2026. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, lingering concerns about interest rates and the Fed flared up on Friday after a surprisingly strong NFP report. We run through our thoughts on why this hit the Nasdaq so hard and note that risks of a Tier 1 garden variety pullback in the S&P 500, a drop of 5 to 10% from peak, has risen near term. Second, other things that jump out include the recent drop in Bitcoin, which supports the idea that risks of a Tier 1 pullback have risen, and the sharp drop in small caps on Friday on interest rate fears. If you'd like to hear more, here's another 5 minutes. Before we jump in the details, we do need a favor. The 2026 Extel, formerly Institutional Investor, survey of sell-side research analysts is open and closes this Friday, June 12th. If you found our research in this podcast helpful, we'd truly appreciate your vote. Go to www.extelinsights.com, scroll down, and look for the black and white voting box on the right. Once in the survey, pick All America Research, Macro, Portfolio Strategy, RBC, and Lori Calvasina. When you input stars, 5 is the highest. There are many excellent competitors in this category, and the rankings get very tight among the top 10 every year, meaning every single vote does count. Now let's get back to regular programming. Takeaway number 1. Interest rate fears paved the path from rotation to de-risking. Worries about rising rates in the Fed have ebbed and flowed in recent weeks and loomed large at a macro gathering we attended last week. We went through how we're thinking about this risk in our May 27th podcast, Everything in Moderation. And if you'd like to go through that math again in terms of the intersection between interest rates and equities in our forecast, we'd encourage you to listen to that podcast one more time. In a nutshell, our modeling suggests that on a longer-term 12-month time frame, U.S. equities can weather a move up in 10-year yields as long as the move up doesn't breach 5%, and can also handle a few hikes from the Fed, admittedly with some near-term indigestion, perhaps in the form of a 5 to 10% pullback. Anything more onerous on the rate side we do see as a more challenging situation for the stock market on a 12-month time frame and our 7,900 price target. Not surprisingly, Friday's May NFP report was viewed by the equity market through the lens of rates rather than fundamentals. Stocks fell sharply after an upside surprise for May and upward revisions to April, which our economics team described as confirming the labor market is strong despite headwinds. For now, good news is being treated as bad news if it stokes fears of higher rates. Beyond interest rate concerns, it was also a case of bad timing for the U.S. equity market. As we highlighted last week, while the forward PE multiples for the S&P 500, Russell 2000, and Nasdaq 100 have generally looked elevated but not back to their most recent highs, something that mitigates deeper pullback risk, the median next 12 months PE of the top 10 market cap names in the S&P 500 has been approaching the high end of its pre- and post-COVID range, adding to pullback risk or at least the idea of leadership rotation. Additionally, we pointed out last week that when we take the ratio of the forward PE of those top 10 market cap names to the rest of the S&P and compare the ratio of those two baskets on long-term earnings growth expectations as well, that a gap has opened up between the two time series, suggesting the relative PE needs to come down and get back to where the relative long-term earnings growth expectations are. We also noted last week that the broadening out of upward EPS estimate revisions beyond the top 10 market cap names in the S&P 500 was supportive of the idea of a short-term leadership shift away from the mega cap growth trade. This week, we'll add a few other data points to our list of reasons to be concerned about further near-term retreat and/or underperformance by the mega cap growth trade. First, the rate of upward EPS estimate revisions for the top 10 market cap names, our gauge of earnings sentiment, is getting close to past peaks. It's at 89% currently, while major peaks in the past have been in the 90 to 94% range. This simply may be as good as it gets from an earnings sentiment perspective for mega cap growth. Something similar occurred last fall when the rate of upward EPS estimate revisions for those top 10 market cap names stalled at 86.5%. The second thing on this list this week is that Nasdaq futures positioning on CFT's weekly futures update has recently spiked up sharply, though it admittedly didn't get back to past highs relative to market cap. And third, on the valuation side, we have seen a little bit improvement in that top 10 market cap PE, but not enough to say that the froth that recently returned is out again. On a very important related note, semis were in the eye of the storm on Friday with a drop of 9.8% in the SOX. While we don't yet have a read on how semis valuations looked as of Friday's close, what we do know was that as the middle of last week when we last updated our chart, the median NTMPE of the Russell 3000 semi and semi-equipment industry was a bit above post-TMT bubble highs, suggesting there was much work to be done in getting valuation levels back to a more reasonable place. Semis have been sitting at peak rates of upward revisions of late as well. We're not seeing any degradation on that indicator as of now, but we'll be watching it closely in the coming weeks ahead of the next reporting season to see if it provides another reason for profit taking in this space. Along with war setbacks and interest rates, we've had profit taking in semis on our list of potential catalysts for a Tier 1 pullback in the U.S. equity market for a few reasons. In our mid-May report, we recapped our conversations from UK and Switzerland client meetings earlier in the month. We wrote at the time, despite the appreciation of the earnings power of the tech semis AI part of the market, and some noting they'd had plenty of exposure to it and had been performing well, there was a keen interest in exploring what other areas might offer better opportunities going forward, though several also noted it was difficult to understand what those would be. Moving on to takeaway number 2, which we'll do quickly, the other things that jumped out in our analysis last week. First, we revisit the tiers of fear. On our tiers of fear drawdown framework, a Tier 1 garden variety pullback 5 to 10% versus peak in the S&P 500 would take that index down to the 68.49, 72.29 range. As of Friday's close, the S&P was already down 3% from peak. Note that deeper drops do generally require recession fears to return in a significant way. Second, the decline in Bitcoin that's been seen of late supports the idea that rotation within the S&P 500 may be turning into de-risking. The pullbacks in the S&P 500 in early 2025 and early 2026 were preceded by drops in Bitcoin, and Bitcoin and the S&P 500 were fairly correlated with one another in 2023 and early 2024. Third, the Russell 2000 got hit nearly as hard as Nasdaq on Friday in the aftermath of the NFP report. While the print was a surprise, the small cap benchmark's reaction to it was not. While small caps tend to outperform when ISM manufacturing is rising, a trend confirmed in last week's update for May, and job growth is accelerating, a trend in place if we overlook the fact that the May NFP number came in a tiny bit below the revised April number. We've also seen that small caps have tended to underperform when hikes are baked into the bond market in recent years or when 10-year yields move up. And before we wrap, a final thought. Tier 1 pullbacks have clearly risen, and megacap growth leadership may stay paused a bit longer, but there has been no change in our longer-term constructive S&P 500 outlook over the next 12 months or our 7,900 price target, which we've been describing lately as higher, but not heroic. That's all for now. Thanks for listening, and very importantly, don't forget to vote. The last day to do so, again, is this Friday, June 12th.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.